This meeting is being recorded.
All right, guys, so now we're going to head into annuities, which will be 11% of your exam. All right, so let's look at some key terms and concepts. Remember, guys, that the annuity is like a glorified savings account. It is a contract established to systematically liquidate a sum of money that can be used often for retirement or other specified needs. The annuitant is the person on whose life the contract is written and who is the recipient of the benefit payments. The owner is the person who purchased the annuity and is responsible for making the payments, which is often the annuitant. And the beneficiary is the person who receives their benefit and should the annuitant die. The accumulation period is also known as the pay-in period and the growth period of an annuity. The owner can make changes during this time. With an annuity period, also known as the payout period of the annuity, this is the time during which the principal and interest are used to make payments to the annuitant. The company controls the annuity during this time, and each payment consists of principal and interest. Also remember that this can also be called the liquidation period or the annuitization period. An immediate annuity is a benefit payment that begins within 12 months of the purchase. It is purchased with a single premium, also known as an SPIA, or single premium immediate annuity. A deferred annuity payments begin more than 12 months after purchase, and it has earnings that grow tax deferred. Okay, so looking at our mountain here, remember that the accumulation period is the pay-in period, and this is where you accumulate money. The payout period, also called the annuity period, a liquidation period, or payout period, is the time where you're receiving income payments. All right, so how are those annuities invested? They can be invested in a fixed annuity, which has a guaranteed minimum interest rate versus a current interest rate and has level benefit payments. The premiums are invested in the insurer's general account. And you can always remember it's the general account because it has the word guarantee. The insurer assumes the risk and it cannot keep pace with inflation. And this is a disadvantage with a fixed annuity. With an equity indexed annuity, these are a type of fixed annuity with the interest rate tied to a familiar index like a standard Poor's 500, the S&P 500. These are more aggressive and less risky than a regular annuity. Variable annuities serve as a hedge against inflation. Premium payments are made into a separate account. You can remember this because there's no guaranteed rate of return, and premium purchase accumulation units and receive annuity units when the time comes. Okay, so looking at our annuities chart, let's look at some questions. So when can I receive my payments again? Immediately within 1 year, or deferred, meaning after 1 year. How many lives can be covered? A single life, which is one life and one life only, or multiple lives, which is joint, survivor, as in first to die, all payments will stop, or joint and survivor, where all payments will continue, then neither one can outlive. So how can I pay my premiums? Remember, with single premium, which is a one-time payment, or flexible premiums, which can be either flexible or level, also known as periodic premiums. How can I invest my premiums? As a fixed annuity with guaranteed rates of return, or as a variable with no guarantees. And those premiums are invested in a separate account, and they must have their life and securities license. So how long are my benefits paid? They can be cash or They can be known as an annuity certain, which are temporary, which means once it's gone, it's gone. And these can be set up as fixed period, as in a fixed period of time, or a fixed amount of money. A life annuity, which is also provides a life income, can also be called a pure or straight life annuity, where there is no beneficiary. Life with period certain, where the annuitant will be paid for life, but will include the guarantee for the beneficiary. A refund annuity, which will also be refunded after whatever's left. This can also be called life with guaranteed minimum, wherein the beneficiary can either be paid a cash refund or a refund in installments, or it can be joint and survivor. So, with the personal uses of an annuities, remember these have tax deferred growth. These can be used for lump sum settlements such as inheritance, winning the lottery, lawsuit settlements. They can be used as retirement income or education funds, or they can be for long term care. Okay, let's question your knowledge. Remember, read twice, select once. Number one, an immediate annuity has no accumulation period, which means it can only be purchased with a level premium, B, fixed flexible premium, C, single premium, or D, variable premium. If you said C, single premium, you are correct. If it's an immediate annuity, it has been purchased with a single lump sum. So there is no accumulation period. Number two, what type of license is required to sell an equity indexed annuity? A, life only, B, securities only, C, both life and securities, or D, limited lines. If you said A, life only, you are correct. In order to sell an equity index annuity, you only need your life license. Number three, an annuity income amount is based on whose life expectancy? A, the owner, B, the insured, C, the annuitant, or D, the beneficiary. If you said C, the annuitant, you are correct. The annuitant is whose life is taken into a consideration and whose life expectancy and objectives are taken into account. Number four, payments from a deferred annuity begin after A, 12 months, B, 18 months, C, 20 months, or D, 24 months. If you had A, 12 months, you are correct. Payments from a deferred annuity began at least 12 months later. Number five, the primary purchase of an annuity is to A, provide guaranteed death benefit, B, create an immediate estate, C, guarantee income for life, or D, provide disability income. If you said C, guarantee an income for life, you are correct. The primary purpose of an annuity is to guarantee an income for life. Number 6, what will the insurance company pay if the annuitant dies during the accumulation period? A, the premiums paid. B, either the premiums paid or the cash value, whichever is greater. C, the amount of premiums paid less the surrender charges and taxes. Or D, the account value. If you said B, either the premiums paid or the cash value, whichever is greater, you are correct. Insurance company will pay the annuitant if they die during the accumulation period, the cash value or the premiums, whichever is greater. Number 7, a fixed annuity has all the following features except a guaranteed minimum rate of interest is credited to the payments. B, they do not impose surrender charges. C, their purchasing power may be eroded over time due to inflation. D, the annuitant knows the exact amount of each payment received during the annuity period. If you picked B, they do not impose surrender charges. That is correct. Remember, a fixed annuity does not impose surrender charges is not true. Number 8, which of the following is true about the annuity period? A, it is also known as the pay-in period. B, the annuity owner is in control of the premiums invested. C, the premiums grow tax deferred. D, the insurance company promises to provide a life income to the annuitant. If you said D, the insurance company promises to provide a life income to the annuitant, you are correct. That is the purpose of an annuity, to provide income in case they outlive their money. Number 9, with which of the following annuities are the earnings based on the S&P 500? Fixed, A, fixed, B, variable, C, equity indexed, D, market value adjusted. Well, if you said C, equity indexed, you are correct. The equity indexed annuity are based on the S&P 500. Number 10, an annuitant bought a life annuity with 10 years certain. He began receiving benefits at age 70 and died at age 74. The beneficiary received A, nothing, B, a lump sum settlement, C, the total of 6 years payments in a lump sum, or D, 6 years of monthly income. If you said D, 6 years of monthly income, you are correct. With 10 years certain, that covers that the annuitant will be paid for life, but the beneficiary will be able to collect any of the 10 years that have not been paid out. So since the annuitant was paid for 4 years, that leaves 6 years of monthly income that may go to the beneficiary. Okay, guys, I'm very proud of you for completing a review. Remember, you are 80% more likely to pass your licensing exam if you use the Pass Now system on Primerica.com. It's super important that you go green on your practice exam and your focus exam. And don't forget those additional resources that are available to you on POL, such as your life exam prep, your life exam review videos, printable flashcards, and test taking tips. And again, if you need any additional study time, your licensing coach is always there for you. Please don't hesitate to reach out.